their capacities in 2010 and 2012. Leave aside the Suzukis of the world that had the large market share. I'm talking about the other players. So these companies have just started increasing capacity. So that's something we are seeing. The capex is coming back. There are certain other areas where private is coming ahead and putting capex, and this is all driven by the premiumization which is happening in the country. That is one. So second, we believe that at least from a growth side, in the investment part, the capital expenditure will continue to increase. The third thing, which is the net exports. This is not typical IT companies, net exports. These are the companies which are now building the scale in terms of achieving the cost of, or the levelized cost of production of what global countries does. And this is all done because the government really came and focused a lot on giving PLIs, giving subsidies to the sectors. And though we have seen some of the companies, we see a lot of flurry of PLIs being applied by across sectors, across companies. But what we see that there are only few companies who are able to build the scale to achieve the cost of production. We eventually became the net exporter for mobiles at the end of the day. PCBs is something, for example, just to tell you, you used to just assemble it, there's no value addition. There are companies who are now starting designing PCBs for the MNCs, that's where the value add comes. So I think net exports is something which is gives you a kind of a growth outlook, or kind of a growth where the companies who have achieved scale, I think they can go in the next leg with respect to the potential increase in the export side. We talk about India. India doesn't spend. I think when you look at in US has not spent in the last 20 years in their power and transmission capex. I still remember in US about 3-4 years back, we used to import about $20 million worth of power, cables, conductors from China. Now they have a sanction there, and they themselves are looking at this point in time that who can help them with that. I mean, you can Google it, it's a public information that they're having so much issue in terms of their transmission lines, their substations. And I think that could be another net export opportunity for a lot of products in India, which I think nobody is looking at it at this point in time. Because theme can go and come, it can happen, and generally that's how the cyclicality of the business is. But we are trying to address in this fund and how structurally, each and every industry we can address, and who are really building the scale here in the country, who can eventually show you strong earnings growth. These are just the things I was talking about in terms of the investment, transportation, defense, utilities, corporate capex. The defense exports is also something now starting to picking up, but I think more of a domestic consumption is where we are more positive. Exports, at least on the electronic side, we have picked up. Same the household income distribution. And it's not that only in India. You look at US, you look at Europe, you look at China, rich is becoming richer at the end of the day. The gap is widening. That's where the premium consumption is really growing on a double digits. The same thing I was talking about with respect to the SUV side, almost 50% is the mix, which is very important for the auto ancillaries, because that's where you increase your content in your vehicle, your ASP starts going up. And that's something we talked about, the net exports, and that's where I talked about sectors like cables and wires, electronics, industrial products. As Shreyas mentioned, that chemical and pharma, we've been long back here. The countries anyway which was doing exports for a longer time, but these are some of the new areas where we believe that the scale has been made and exponential growth can be expected over the next 2 to 3 years. Just a case study of some of the ecosystem which is being made. And this is just the construct of the index. The manufacturing index is it's been more of 27% autos, followed by cap goods of 21%, and healthcare about 15%, chemical is about 11%. So that's been the manufacturing index construct. So that's all I wanted to convey regarding this fund, regarding the thought process behind the fund. Happy to take any questions if you have.
You talked about the index construction. Why not a passive fund instead of an active?
So this index is represented here as more of a representation. So this is a benchmark for this fund. So just to give an idea to investors that what they are investing into, by giving a proxy, benchmark as a proxy to it. It's not necessarily the fund is going to be exactly this way. But this is just a broader idea one can get. So like in any other fund, when you invest, you normally look at it what is the benchmark, and then you get broader idea, right? In what you are investing in. So that's the idea is more to do with that.
What about cost of manufacturing? That is also very high. That's one of the reasons why manufacturing didn't take off in India, basically, and government stepped in. So, do you think now the foundation is set for being competitive on the cost front?
So this cost as such is it depends it different for different sector, and that's what we are trying to highlight. Is some of the items where say China or some other countries they are having a global scale. Now at global scale the costs are anyway going to be lower, right? Till the time you achieve that global scale, it's not about a country also, it's about the scale first. It starts with that, how much you are producing out of 1 unit. And then if you try to drill down on various reasons, in which sector, where you have cost advantage, for what reason, and then if you just try to slice and dice among the sectors, then you will realize that in some sectors inherently, because of the talent we had advantage in, and that's where I highlighted some of the sectors like chemical, pharmaceutical, or auto mechanical engineering associated with that. And in that we have been doing it for multiple decades, right? Many of the companies in auto already are manufacturing in India and exporting to some of the other countries. So that process is already on. Probably in the sectors where the scale is huge, which is achieved by some of the countries like China, Vietnam, Taiwan, those components which especially come into this electronic manufacturing services where they have a high scale. So on those things, obviously, that's where the government is coming in and trying to ease out them for that, so that they can manufacture in India. So it's normally the long process. Immediately you cannot have the lowest cost in any particular industry. Once you have to give some benefit, then it starts, then you achieve scale, and then on its own you become cost competitive.
Good afternoon, sir. This is Sujata here from News Plus News.
So we, as a Axis AMC, so we are the investors, and our attempt is always to invest in areas, the sectors, subsegments of listed entities, wherein we can make invest into it and try to gain returns for our investors. So in that attempt, we always try to evaluate multiple sectors. It can be manufacturing, it can be services, it can be financial services, IT, multiple such sectors. So that is always our attempt to try to find out which sectors, which segments are doing well, and then trying to make returns for our investors.
Now, I want to understand the risk part of it, which has been highlighted. Why that riskometer is very high?
So, if you look at the risky part, though we believe that structural drivers are very strong at this point in time across the sectors, whether it's the consumption, investment, and the net exports. There's one area where we are not comfortable. Let's say the risky part is on the valuations, right? Now, when I say valuations, it's something the B2B businesses in the country are available at B2C valuations today. And obviously, they are available because the growth is very strong. I mean, you look at capital goods companies, earnings growth have been phenomenal. They're growing at what, 40% in 2021, 30%, and then 20% growth is continuing still, and despite being on a higher base. But valuations is something on that construct of the index. If you look at the cap goods, which is 21% of the index, that's where only the valuations are quite high. When you look at the other segments, whether it's autos, healthcare, metal, chemical, optically you are not at a very high valuation. That's the only area where we are a little cautious on that part. Sure, you want to add anything?
I'm just adding to it to make it slightly more broad-based, in a sense that if you notice that when you look at any risk of any product, the risk, if you see, risk reduces by diversification and it increases by concentration. Right? So any product like this, which is theme or sector oriented, few sector oriented. If you choose one single sector, then it is your diversification less or risk is goes high. If it is few sector, the risk is relatively less, but is higher than most diversified product. And that's how when it comes to any theme for that matter, it tend to go higher on the riskometer for this point of view. So it is about product as well as what Nitin was highlighting, that in the next level of risk is whether whatever your segments of it are there, whether what violations they are and all. That also plays a role. So it's a combination of multiple.